Welcome back to the Deep Dive. Today, we are not just wading into the deep end of digital infrastructure. We are performing a rigorous ground-up inspection of a company sitting right at the most volatile yet, potentially lucrative, cross-section of the modern financial landscape.
That's absolutely right. As of late 2025, the investment environment is just defined by this incredible tension. It's a tension that dictates the hurdle rate for really every single dollar of risk capital out there.
And on one side of that tension, you have Bitcoin.
Exactly. You've got Bitcoin, which has, I think it's fair to say, largely cemented its position as a major geopolitical monetary asset. It's trading resiliently, pretty stably between, $86,000 and $89,000. That suggests a kind of mature acceptance.
But then you have the reality of the traditional financial system sort of fighting back against that exuberance. The U.S. 10-year Treasury yield is demanding attention, sitting firmly right around 4.04%.
And that's a high number.
It's a very high number. That yield means any asset you invest in, especially in the technology or commodity sector, it has to demonstrate a substantial defensible return just to justify the risk. It sets a really high bar for profits.
And the company we are dissecting today, HIVE Digital Technologies Ltd, or just HIVE, it sits exactly at that volatile intersection of the reliable utilities sector, the Bitcoin long game, and the explosive high-demand AI supercycle.
And here's the immediate fundamental contradiction. It's the thing that sends the retail market running, yet it's what draws in the deep value institutional investors. When HIV reported its fiscal year 2026 Q2 results, the headlines just screamed about a GAAP net loss.
Right.
So on the surface, it looks like just another unprofitable tech stock. But when you apply our framework and you really look beneath that noise, you uncover substantial, robust operating cash flows that are completely obscured by specific, yet I'd argue, prudent accounting methods.
So our mission today is to cut through that sensational noise and perform a classical analysis. We are applying a very traditional, rigorous, you could even say a Warren Buffett-style value investing framework to this highly non-traditional digital asset infrastructure sector.
We're looking for the basics.
We're looking for durable competitive moats, disciplined capital allocation, and a genuine margin of safety. All the things you'd look for in a blue-chip stock, but in this space.
And we are going to tease the conclusion right up front because the data really demands a strong, clear verdict here. Our analysis suggests that HIVE is executing a fundamental and, I think, a largely misunderstood transition.
I agree.
They are moving aggressively from what was once pure speculative mining into a diversified, defensible digital infrastructure utility. For the patient investor, this looks like a genuine, deep value opportunity in a non-traditional sector.
And to properly validate that claim, we have to apply a rigorous framework. We need to dissect the durability of HIV's competitive moat. We need to evaluate the rationality of management's capital allocation decisions over the last several cycles, and, crucially, determine the true margin of safety currently offered by the stock price.
Which seems totally disconnected from the underlying assets.
It seems disconnected from reality, and this entire transformation thesis, it really hinges on what management calls their twin turbo approach, combining that volatile but low-cost proof-of-work mining with stable, high-margin, enterprise-grade AI compute capacity.
Okay, let's unpack this and get into the material. Part 1. Chapters 1 to 3. Business, Management, and Financials. Chapter 1. Business Understanding. So the core of the HIV story, and really what separates them from a lot of their peers, is understanding the functionality of this twin turbo engine. And it's not just some marketing term, it's the operational reality.
Right. They have successfully moved far beyond the simple concept of crypto mining as just, hashing arbitrage.
It's not just plugging in a machine and hoping for the best.
Not anymore. They are now truly a vertical infrastructure manager. So you've got one engine Bitcoin mining that provides the volatile, high-growth, high-beta potential tied directly to the price of the commodity.
And then there's the second engine.
The second engine, HPC and AI cloud services, which they've branded as BUZ, is designed to deliver stable, recurring, enterprise-grade revenue streams. It's the stabilizer.
What's fascinating here is how the two divisions are, strategically balanced. The Bitcoin mining side is purely about industrial scale and really surviving the cyclical halvings.
It is, and HIVE has achieved a scale that places them firmly in the upper echelon of publicly traded miners. I mean, we're talking about an operational hash rate of approximately 25 exahash per second. That's as of the Q2 reporting period.
That is serious top-tier capacity. That puts them in the same breath as some of the largest U.S.-based competitors, right?
It does. But, like we established, in a pure commodity business like this one, scale is utterly meaningless without efficiency. The single most critical factor, the lifeblood of survival, is minimizing the marginal cost of production.
It just doesn't matter how much hash power you have. If it costs you more to mine the Bitcoin than you can actually sell it for.
Exactly. And that is why the conversation must begin with what is arguably HIVE's most strategic and durable asset, the Paraguay pivot. This is the bedrock of their long-term cost moat, and it's why they look fundamentally different from their peers.
Okay, the sources frame this as the Paraguay pivot, a strategic masterstroke. That sounds a little dramatic. What makes it a masterstroke rather than just another geographic expansion?
Well, it's the deliberate avoidance of the risk profile taken by so many of their largest U.S.-based peers. While competitors were chasing the perceived cheap but highly volatile energy of the deregulated ERCOT market in West Texas.
Or you get those crazy price spikes in curtailment.
Exactly, where you face peak demand pricing and mandatory curtailment HIVE, pursued a strategy of sovereign diversification in a region with enormous, stable, renewable baseload power.
So tell us more about the power source itself.
They have this massive expansion at the Iguazu site, and they're leveraging capacity that will eventually reach 300 megawatts, all powered by the Itaipu Dam.
And for context, the Itaipu Dam is, what, one of the biggest in the world?
It's one of the largest hydroelectric facilities on the planet. It generates clean, stable energy far in excess of Paraguay's own domestic needs, and that creates a durable, reliable surplus.
And the competitive advantage flows directly from that reliability, I assume.
Precisely. By tapping into that massive baseload surplus, HIVE can lock in fixed-price power purchase agreements or PPAs. This is the durable cost advantage, predictable power costs.
So no surprises on the energy bill.
No surprises. It insulates them completely from the rapid energy price volatility, the crippling peak demand pricing, and the mandatory curtailment mandates, where the grid literally forces you to shut down to prevent brownouts that plague their U.S.-centric peers. They don't have to spend millions hedging natural gas futures or worrying about the grid shutting down on a hot summer afternoon in Texas.
But you mentioned emerging markets diversification. While the power source is obviously robust, isn't there an inherent geopolitical or regulatory risk in a country like Paraguay that might offset that low cost?
That is a critical point, and the sources show HIVE is acutely aware of it. I mean, they utilize local partners, W3X SA and Ryder and CISACI, to integrate their high-voltage infrastructure directly into the national grid, which minimizes transmission losses. But the real evidence of their discipline is their restraint.
You're talking about the fact that they demonstrated agility and discipline by capping expansion at one point?
Yes. The sources note that HIVE kept one specific instance of investment at 100 megawatts. Why? Because of unexpected fiscal policy changes that increased the future regulatory uncertainty in that specific region.
So they walked away from a deal.
They literally walked away from a cheap power deal because the regulatory environment became less certain. They refused to chase hash rate growth at the expense of regulatory certainty and, more importantly, a superior return on invested capital. That ability to walk away when the deal sours is the hallmark of rational management. It's what distinguishes them from the growth at any cost crowd.
Okay, so let's talk about the hardware side of the mining division, fleet modernization and efficiency. The next halving mandate is the ultimate economic reality check for this whole sector. You have to constantly improve efficiency just to maintain your current position.
Survival in the post-halving world is measured in joules per terahash, or JTH. It's a pure metric of energy efficiency. HIVE has aggressively upgraded its fleet, and they're averaging an exceptional efficiency of between 17.7 and 18 JTH by late 2025.
And that's largely due to new hardware.
It is. This achievement is heavily reliant on the deployment of liquid-cooled Bitmain S21 plus Hydra units, primarily in those new facilities in Paraguay.
Let's stop there and really detail the technical implications. Why is liquid cooling so critical here? It sounds high-tech, but what does it actually do?
Well, it addresses three core problems at the same time: efficiency, longevity, and climate resilience. First, efficiency. Liquid cooling allows the complex ASIC chips to run at higher frequencies or operate closer to their thermal limits without something called thermal throttling.
So they just get more power out of the same chip.
Significantly more hashing power per watt consumed. Second, It extends the hardware's lifespan because it dramatically reduces thermal stress cycles. And third, and this is maybe the most practical point in Paraguay, you are dealing with a humid subtropical climate.
Where air cooling would be a nightmare.
A nightmare. It's notoriously inefficient, it's unreliable, and it's prone to rapid corrosion and failure. Liquid cooling basically turns that environmental variable into a non-issue, ensuring continuous operation and protecting that massive capital expenditure.
So if we try to quantify that efficiency, 17.7 JTH, what does that efficiency gain translate to in actual dollars saved per Bitcoin mined compared to a competitor who's running older equipment at, say, 30 JTH?
That gap is literally the difference between survival and bankruptcy in a bear market. If the average network difficulty is high, a 30 JTH miner, especially one paying volatile grid prices, might have a marginal cost of production, and this is excluding depreciation of around $50,000 to $60,000 per Bitcoin.
Okay. And HIVE?
HIVE, with their 17.7 JTH and their fixed low hydro rates, might have a marginal cash cost of production closer to $35,000 or $40,000.
Wow.
So when Bitcoin is at $87,000, that difference is just pure gross profit. But when Bitcoin drops to $55,000, that difference is your entire margin of safety. It's everything.
I see. So when Bitcoin network difficulty is hitting these record highs, HIVE's combination of high-efficiency hardware and the lowest-cost power globally provides that necessary margin of safety for positive gross mining margins, even if the price of Bitcoin takes a significant dip down to, say, $50,000.
Exactly. That low-cost, high-efficiency, sovereign diversified structure creates a competitive moat that purely leveraged high-cost miners who are exposed to high U.S. energy volatility, they just can't replicate it. It ensures HIVE is one of the last miners standing, ready to scoop up market share during those capitulation cycles.
Now, for the second engine, the HPC and AI division, or BUZZ. This is where the company fundamentally transforms that speculative, cyclical mining infrastructure into high-value, enterprise-grade data centers for training and running large language models. This is the pivot that, if it's successful, fundamentally changes the valuation multiple of the entire company.
And the infrastructure jump required here is enormous, and this is the core execution risk that the market is discounting so heavily. I mean, a Bitcoin mining farm is a highly specialized, power-intensive warehouse. An AI data center has to function like a precision laboratory.
So they're converting these old facilities.
They're converting their legacy Canadian facilities in Lachute and Grand Falls and their Swedish facility in Boden to meet rigorous Tier 3 standards.
Let's define Tier 3 standards quickly, because that's not something a typical crypto miner ever has to deal with.
No, not at all. Tier 3 requires N+1 redundancy. That just means you have an extra component for every single critical system, so no single failure can take the whole system offline. It means strict environmental controls, massive bandwidth availability, and guaranteed uptime.
It's the difference between a facility that can tolerate an hour of downtime versus one that needs 99.999% reliability.
Exactly, the kind of reliability demanded by enterprise service level agreements, or SLAs.
And they've attached some significant tangible targets to this transition. They are targeting an annualized revenue run rate of approximately $140 million by late 2026.
Which is an explosive growth rate.
It's a truly explosive growth rate, up from an estimated $20 million run rate in 2025. That's a 7-fold increase predicated solely on execution.
And this is why the crucial validation of this strategy is so important. We can look at the projected revenue growth, but you need proof they can actually execute. That proof comes in the form of their partnerships with blue-chip companies like Bell Canada and Dell Technologies.
And what are they deploying?
They're deploying a 63-node cluster of liquid-cooled Dell PowerEdge XE9680L servers, and these are equipped with the latest NVIDIA H100 and H200 GPUs, top-of-the-line stuff.
Wait a minute. Bell Canada requires 99.999% uptime for their services. HIVE is effectively repurposing what were once crypto warehouses. Is there a scenario where the execution risk on that complex, high-reliability infrastructure conversion is just massively underestimated?
That is the right question to ask, and the market is applying that exact discount right now. However, Bell Canada selecting HIVE as a partner effectively validates HIVE's infrastructure quality after the conversion.
So it's like a stamp of approval.
It is. Bell doesn't partner with companies that might fail in SLA. This partnership reduces that execution risk discount that the market otherwise applies to any crypto miner trying to enter the enterprise space. They've proven they can bridge the gap to enterprise-grade IT.
This leads directly to their sovereign AI thesis. They aren't trying to beat Amazon AWS or Microsoft Azure on pure scale, are they?
No, not at all. They're offering a highly differentiated service. They are boutique, private cloud alternatives located in secure green energy jurisdictions like Canada and Sweden.
And why is that important?
Because large enterprises, governments, specific research institutions, they're all increasingly wary of relying entirely on the few dominant hyperscalers for data privacy, for compliance, and for dependency reasons. HIVE is leveraging its existing low-cost power assets to command premium pricing for these specific sovereign clients, and that could potentially deliver a superior return on invested capital compared to just trying to build a generic data center business from scratch.
And the geographic diversification as a moat ties the whole strategy together. They're operating in 3 distinct regions, each serving a specific strategic function.
Absolutely. Paraguay provides the lowest global cost for the baseload commodity mining. That's the defensive engine. Sweden, specifically their site in Boden, serves as a hub for HPC and AI, capitalizing on European data sovereignty demands and offering unique environmental benefits like waste heat recycling for strong ESG compliance.
And then Canada.
And finally, Canada offers the high-end HPC AI cloud services, proximity to North American fiber backbones, and, the obvious cold climate advantages for supplemental cooling.
So what's the ultimate payoff of managing this complex tri-regional portfolio?
It sounds like a headache. It's an intangible asset, capital allocation optionality, and political insulation. This diversification protects them against single-point geopolitical or regulatory failures. Think sudden U.S. tariffs, a change in Canadian energy policy, or those ERCOT grid issues we talked about. If one region becomes politically or fiscally unfavorable, management can just shift its capex and investment to the others. That is a luxury many of their U.S.-centric competitors simply do not possess. Chapter 2. Management evaluation. So, moving from the asset base, we have to evaluate the people running the show, and we apply the ultimate litmus test here, the Berkshire Hathaway standard. Management is judged by rational capital allocation over long cycles, not by stock promotion or short-term gains.
And HIE's leadership dynamic is fascinating because it seems to be a deliberate blend. You've got the financial macro strategist and the engineering technical operator.
Right. Frank Holmes, the executive chairman, is the macro strategist. His extensive background is in resource investing, particularly gold, and that provides the framework for his view of Bitcoin as digital gold, where he emphasizes extraction costs and store value.
He's the big picture guy.
He's the big picture guy. He is the public, vocal proponent of the AI supercycle and has been instrumental in raising the necessary equity capital through his connections.
And then you have Aidan Killick, the president and CEO, who is the technical operator. He comes from an engineering background, and his tenure has really been defined by successful execution during pivotal moments.
The most impressive being the Ethereum merge.
Exactly. He successfully repurposed the entire Ethereum GPU fleet for HPC workloads almost immediately after the merge. His focus is strictly on ROI-driven growth over hash rate at any cost.
And this blend is absolutely crucial. You need Holmes's capital markets savvy to fund aggressive infrastructure deployment in a sector that's starved for capital, but you need Killick's technical rigor to ensure that capital is deployed efficiently, targeting that 18% ROIC rather than being squandered on obsolete hardware or high-cost energy contracts. It prevents the company from chasing reckless growth just for market visibility.
But let's address the elephant in the room regarding capital allocation, the dilution trade-off. The company relies so heavily on at-the-market or ATM equity programs to fund growth. And investors, they hate dilution, especially in a sector where share counts can balloon so rapidly. Why should we believe the 18% ROIC target justifies the constant ATM use?
It is the primary criticism, and it is a valid one if the capital is deployed poorly. However, management's counter-argument is that this dilution is accretive, that it actually adds value per share, because the capital is deployed almost immediately into income-generating assets, ASICs and GPUs, that are modeled to target an 18% annualized return on invested capital.
So they believe they're selling equity at a discount to immediately buy assets that generate a superior return.
That's the argument, and that focus on a specific high ROIC target is highly unusual in this sector, where the goal often just seems to be sheer exahash growth for market share, regardless of the cost basis.
It speaks to a deep underlying financial conservatism. And this conservatism seems to be anchored by their anti-fragile balance sheet. They explicitly refuse to take on toxic, high-interest debt.
Right. HIVE's debt-to-equity ratio is negligible. It's hovering around 2.9% against over $600 million in shareholder equity. They prioritized corporate survival and anti-fragility, and they avoided the high-leverage failures that crippled peers like Core Scientific during the 2022 crypto winter. This debt discipline means they aren't forced to sell their Bitcoin inventory or raise toxic debt during downturns.
Okay, we also have to address governance and related party scrutiny. Holmes's involvement with U.S. global investors means there is some overlap in shared resources, staff, leadership. Is this just typical resource sector overlap in transparency, or is it a sign of potential control risks that investors should be worried about?
It absolutely requires scrutiny from investors, there's no doubt. The filings do show transparency regarding the transactions and shared services, which is positive. But ultimately, investors are betting heavily on the synthesis of Holmes's ability to navigate capital cycles and Killick's ability to execute these complex technical pivots without misallocating funds toward related parties.
And the high hurdle here is crystal clear.
It is. Because they rely on continuous equity issuance, the ROIC on new machines must consistently, year after year, exceed the cost of equity for shareholder returns to truly compound. Any misstep in deployment, and it hits the shareholders immediately. Chapter 3, Financial Health. All right, this is where we transition from the strategy to the hard numbers. We need to move past the sensational headlines to truly understand the cash flow mechanics of HIVE, especially following those Q2 FY 2026 results released in November 2025.
Okay, the income statement. Revenue versus reality. Let's start with the positives. They reported record growth. Revenue hit $87.3 million, which is a massive 285% increase year over year.
And that's driven by that expanding 25 EH's hash rate and, of course, rising Bitcoin prices.
Right, and gross operating margin was strong at $42.4 million, or 40.6%, thanks to the efficiency of that new S21 Plus fleet. I mean, that is a fundamentally healthy business operation.
But then you see the headline that just killed the stock price momentum. A GAAP net loss of $15.8 million. And this is the crux of the market dislocation, what we can call the depreciation distortion. HIVE uses a highly aggressive 2-year depreciation schedule for its ASIC mining rigs.
Okay, why only 2 years? That sounds unnecessarily punitive for the reported earnings.
It's financially conservative, but it's optically damaging. Management knows the Red Queen problem, ASIC technology obsolescence, is rapid. While a machine might technically run for 5 years, it might be economically inefficient after only 2.
So they're reflecting reality on the books.
They're reflecting the economic reality of the hardware's useful life, which provides a massive tax shield, and that minimizes cash tax outflows. But this huge non-cash charge absolutely crushes the reported GAAP earnings.
So the company looks unprofitable on paper, which makes it unappealing to passive funds and traditional investors. But it's actually a brilliant tax strategy that's masking the true operating profitability.
Precisely. For the astute investor, the trust metric is adjusted EBITDA. HI reported $31.5 million in adjusted EBITDA for the quarter. If you annualize that, it puts the core cash-generative business on a run rate of over $125 million per year.
And that $125 million is the true earning power.
That is the true earning power the market is simply ignoring because it stops reading after the GAAP net loss headline.
Now for the balance sheet, a fortress of liquidity. As of September 30, 2025, they had $47 million in cash and digital currencies. In this industry, cash is king.
That liquidity buffer is non-negotiable for survival. It ensures they don't face a forced Bitcoin liquidation during market dips just to cover operational expenses or debt obligations. And this supports their HODL strategy.
So they hold, what was it, 2,604 Bitcoin?
Right, all of which they mined below the current market cost. So they possess a significant cost basis advantage. They strategically balance selling a necessary amount of coins for OPEX with retaining the rest for asset appreciation, maximizing their exposure to the macro Bitcoin tailwind.
And we cannot overstate the importance of their leverage discipline, especially with the 10-year Treasury yield being over 4%. A negligible 2.9% debt-to-equity ratio means they have almost zero interest payments eating into their profits. That's a massive advantage over peers who are struggling with high interest coverage ratios.
Which brings us directly to valuation multiples and relative value. When you contrast HIVE against peers like Mara, Riot, and CLSK, a really compelling statistical argument emerges from the deep dive sources.
Okay, specifically, let's analyze the price-to-book, or PB, ratio. HIVE trades remarkably low, around 1.0 to 1.1x book value. The sources suggest this PB acts as a theoretical floor of safety, a classic value signal.
And this is absolutely key to the value thesis. Their book value is not composed of, abstract goodwill or questionable intangibles. It consists of two highly tangible, highly valuable assets. liquid Bitcoin inventory, and built-out income-generating power infrastructure, 540 megawatts of total power capacity.
But here's my question. Is book value reliable when the hardware depreciates so fast? If the ASIC value drops to zero in 2 years, isn't the book value inflated, even if it is technically tangible?
That's the subtlety, and that's the right question. Yes, the ASICs depreciate fast, but the long-term value lies in the energized power portfolio. Buying a business at book value, where that book value is underpinned by industrial power infrastructure that costs far more to replace today and with zero long-term debt, offers a classic Benjamin Graham-style margin of safety. You are essentially getting the high-growth AI and Bitcoin optionality for free.
The market dislocation is also clear when you look at their compressed EBITDA, which is sitting at, 9x to 12x forward estimates. That has to be the small cap discount.
It is. The market is implicitly pricing HIVE as if it's valuable infrastructure assets. The 540 megawatt portfolio and the rapidly growing AI revenue stream will simply stop generating cash flow in 2 years. It's perfectly aligning with their aggressive depreciation schedule.
So it's a total misunderstanding of the assets.
It is. This gap between the GAAP accounting value and the long-term utility value of their infrastructure is the single most important reason the bullish thesis exists. It requires the market to eventually accept that HIVE is selling power and compute, not just speculating on crypto.
This level of analysis takes incredible discipline and depth, and we have only just covered the operational foundation of HIVE's story.
That's right. And to keep diving deeper into complex companies like this one, and to ensure you have the full, unbiased picture, make sure you take a moment right now.
Like and subscribe to Stock Analytics AI.
And for $4.99 a month, you get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives into stories just like this one.
Part 2. Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment. HIV's stock price movement in late 2025 is really a textbook example of how operational execution, as we just saw in the cash flow metrics, can be completely decoupled from market pricing, which is instead driven by short-term macro winds and political trends.
We saw this immediately after the record earnings release, what we can call the sell the news reaction. Despite delivering record revenue, strong gross margins, and that $31.5 million in adjusted EBITDA, HIVE shares actually declined by 2.2%, dipping to $2.89.
And this is the critical inefficiency. The retail market sees the GAAP net loss headline, driven by that non-cash depreciation charge, misunderstands the underlying cash flow, panics, and sells.
And this short-term dislocation is precisely what creates the profound long-term opportunity for the value investor who has actually done the work to understand the underlying EBITDA strength and the assets.
It's a pricing lag, really.
Absolutely. The volatility of the price is driven by the fact that HIVE is forced to report using a traditional financial framework, GAAP, that just does not adequately capture the capital intensity and rapid obsolescence of digital infrastructure. It creates this lag.
And beyond the immediate news flow, we have the larger geopolitical context influencing all crypto miners, the Trump trade bifurcation.
Right.
So the anticipation of a potential pro-crypto regulatory environment where Bitcoin might be further integrated into strategic corporate or even national reserves, that creates a massive macro bull case for the entire sector, including HIVE's HODL-led Bitcoin inventory.
But the bear case is the potential for protectionist policies, specifically tariffs on imported Asian electronics, which is where virtually all Bitcoin mining hardware and increasingly GPUs are sourced. Hardware procurement capex could skyrocket globally if substantial tariffs are imposed.
But here is where HIVE's geographical strategy provides a unique and I think unpriced hedge. The market is treating all miners as if they're equally exposed to U.S. trade policy.
And that's the nuance that is currently mispriced. Most large U.S. competitors focused solely on Texas or Georgia are directly exposed to those potential U.S. tariffs, which could destroy their future ROIC targets.
Whereas HIVE,
by importing equipment directly to non-U.S. jurisdictions like Paraguay and Canada, can potentially bypass those U.S. import tariffs. Now, while tariffs still raise the global price of equipment, HIVE is strategically less exposed to the direct impact than its peers focused solely on U.S. growth. This is a crucial defensive advantage that the market is completely ignoring.
Finally, let's look at short interest and analyst divergence. The short interest is moderate, around 5.6% of the float, or 13 million shares.
A moderate short position suggests market apathy or maybe skepticism, rather than a strong, crowded conviction that the company will collapse. And market apathy, the lack of a massive short bet, often precedes a significant value re-rating.
So when the performance finally forces the price to align with the cash flow.
The price can move very quickly without a large short squeeze complicating a breakout.
And the analyst community seems split, which I guess reflects the complexity of this hybrid model. You've got firms like H.C. Wainwright setting ambitious $10 price targets, citing the successful AI execution and high ROIC potential.
Right. While the broader market remains cautious, perhaps because of the persistent AI bubble narrative or just that gap loss. The key insight here is the divergence itself. Traditional resource analysts view it through the lens of cost of extraction, while tech analysts are focused on the quality of the H100 deployment. JP Morgan, for instance, has noted they favor pure-play HPC pivots, which suggests HIVE needs to rapidly demonstrate that the AI segment can stabilize revenue and justify the complexity of the dual strategy.
Chapter 5. Ownership structure. The shareholder registry reveals a silent and, I think, a highly significant accumulation happening just beneath the surface. HIVE is slowly moving away from being a purely retail speculative stock toward attracting sophisticated institutional allocators. Institutional presence has stabilized around 24%. And what stands out is the composition of those institutions, what you'd call the quants arrive. We're talking about firms like Two Sigma, Millennium Management, and Tidal Investments.
And this is perhaps one of the strongest statistical validations of the thesis. These quantitative funds, they don't buy based on management narratives or media hype. They buy based on statistical profiles, low PB, high cash flow generation from EBITDA, correlation factors, volatility metrics.
So their algorithms are picking up the dislocation.
Their presence suggests that HIV's underlying non-GAAP metrics are triggering buy signals in their algorithmic models, indicating that smart money is interesting purely because of the financial dislocation we talked about in Chapter 3.
And passive ownership through ETF flows, like the VanEck Digital Transformation ETF, also ensures a baseline of demand, which benefits HIVE regardless of the individual stock sentiment.
And the insider alignment is healthy and reassuring. Insider ownership is stable at 9.4%, which shows a solid level of skin in the game. And critically, we observed no significant open market insider selling in the lead-up to the November earnings release.
Which signals confidence.
It signals management confidence in the long-term strategic pivot and the valuation, even as they continuously dilute equity via the ATM.
And we must return to the dilution dynamics. Management uses that at the market, the ATM equity facility, constantly to fund expansion. This requires continuous critical monitoring from investors.
The crucial check for any investor is monitoring intrinsic value per share. The share count must not grow faster than the book value plus the accretive earnings power. With the stock trading near book value right now, the accretion math on new ASIC and GPU purchases is tighter.
So discipline is paramount.
It is. Management discipline in using the ATM is absolutely paramount. They must ensure that every dollar raised buys assets that genuinely accelerate value, otherwise that dilution becomes destructive. If the ROIC drops below the cost of equity, the dilution becomes a net negative for long-term shareholders. Chapter 6. Risk Assessment. So now we have to invert the thesis, apply the Benjamin Graham rule, and assess exactly how an investor loses money here. HIVE is operating in a high beta sector with significant external dependencies.
Risk number one is the fundamental uncertainty, commodity price risk on Bitcoin. The company's revenue is still 80–90% correlated to the BTC price. If Bitcoin collapses below the industry, marginal cost, which is estimated around $45,000 to $50,000 HIVE, will begin burning cash, regardless of how efficient they are.
The mitigation here is HIVE's unparalleled cost structure, which acts as a shield. We already established that the Paraguay hydro facility provides some of the lowest industrial power rates globally. In a prolonged bear market, when Bitcoin drops to that critical $50,000 level, HIVE is strongly positioned to be one of the very last miners standing.
So they can outlast the competition.
They capture market share as high-cost, leveraged competitors capitulate and shut down, effectively cleaning up the market for the next cycle. Their low-cost power is their insurance policy.
Okay, we also face regulatory and geopolitical risk. While Paraguay offers stability now, emerging markets always have the risk of resource nationalization or sudden regulatory shifts. I mean, HIVE proved this risk itself when they prudently capped their expansion due to those unexpected fiscal changes, indicating that political stability is not guaranteed.
And we circle back to tariff risk. Even if HIVE bypasses direct U.S. entry for its hardware, U.S. import tariffs on GPUs and ASICs still raise global capex prices, meaning HIV has to pay more globally for the same equipment, which affects their ROIC and makes their asset purchase math that much tighter.
And let's discuss technological and execution risk. The Red Queen problem, that rapid ASIC obsolescence, means they require constant, huge capital investment just to maintain their competitive position in mining, and that capital is being raised through continuous dilution.
And the AI pivot introduces a terrifying new layer of technological risk. HIVE is banking heavily on acquiring NVIDIA H100s and H200s. If competing architectures, like AMD's Instinct series or custom TPUs from the major tech giants, prove significantly more efficient for specific enterprise workloads in the next 18 months.
Their expensive inventory could depreciate rapidly.
It could. Their expensive, liquid-cooled NVIDIA inventory could rapidly depreciate in the eyes of their enterprise clients. They could be left holding the wrong technology.
Furthermore, they face stiff AI competition. They're competing with hyperscalers like Amazon, who have unlimited capital, and aggressive VC-backed specialists like CoreWeave.
Right. HIVE's core advantage is power availability and control over their physical assets, but they have to rapidly prove the quality and ease of use of their software and service layer. If the AI demand unexpectedly slows down, or if they fail to secure those high-margin enterprise contracts, they are left with high-spec data centers needing to fall back on lower-margin commodity crypto mining.
So it's a complex, high-beta risk profile.
It is, but it brings us back to the core insight, the margin of safety. The downside is fundamentally capped by tangible assets. Even in a catastrophic scenario or forced liquidation, the hard floor value consists of 540 megawatts of energized, built-out power infrastructure across multiple continents and the 2,600 held Bitcoin. Buying the stock near book value offers a crucial asymmetric risk-reward profile. The potential upside is leveraged on two secular tailwinds. The risk is constrained by tangible utility assets and a debt-free balance sheet.
Chapter 7. Conclusion. As Warren Buffett always says, price is what you pay, value is what you get. After applying this rigorous critical framework to HIV's unconventional business model, what is the final verdict on the true value proposition here?
Well, the summary of the thesis is clear and it remains highly compelling. It is trading near its tangible book value, it is debt-free, it has superior liquidity, and it has a massive, high-growth, high-margin AI segment that the market is almost completely ignoring because of the noise created by gap accounting.
And the twin turbo strategy is operationally rational and, I'd say, defensive. You're combining low-cost hydro for commodity mining and leveraging those high-reliability Canadian and Swedish sites for premium AI compute. This diversification minimizes your exposure to any single political or energy market risk.
And the operational evidence, specifically the Q2 FY 2026 results, confirms the turnaround and the validity of the infrastructure investment. You've got record revenue and expanding margins that are only masked by the conservative, rapid depreciation accounting they employ. The cash flow is fundamentally there.
So the final recommendation, what is the action item here for someone listening?
The verdict is accumulate. This is a deep value infrastructure play. The market is valuing them solely as a speculative, leveraged crypto miner, but they operate functionally as an energy utility with computational optionality.
And the upside is essentially uncapped, leveraged entirely on two massive secular tailwinds: Bitcoin monetization and the insatiable multi-decade demand for AI compute capacity.
And the downside is protected by that debt-free balance sheet and the tangible power infrastructure. HIVE is fundamentally a growth stock that is temporarily disguised as a value trap by its own conservative accounting practices.
So here's the final provocative thought for you to explore. Given that HIVE's massive 540 megawatt power portfolio, which is already built out and energized, costs significantly less on the balance sheet than its replacement value in today's high capex, high interest rate world, will the market eventually re-rate HIVE based on this underlying utility-like infrastructure asset value?
And if that infrastructure value recognition happens, if investors start pricing them based on their power capacity and data center quality rather than their daily Bitcoin production, it would fundamentally break HIVE's current correlation with pure crypto speculation. That recognition is the ultimate long-term thesis that the current valuation absolutely ignores.
That is a deep dive completed. Thank you for joining us as we unpack the complexities of HIVE Digital Technologies.
Remember, knowledge is most valuable when it's understood and applied.
Like and subscribe to Stock Analytics AI.
This deep dive is based entirely on AI-analyzed research and should never be considered financial advice. We encourage you to use this information to conduct your own critical thinking and independent research.
Until next time.
Dig deeper.